Hey guys, happy Friday. Thanks for joining us live if you happen to be here live. Otherwise, thanks so much for watching the replay. So the plan for today is really just to kind of go through the very basic fundamentals of understanding how to analyze the investment quality of an investment property. So of course, you guys know I am who I am. So we've created this fun little calculator that we can use. And I'm going to just walk through this calculator with you very quickly. It's going to be a short one today. The idea here is that we want you to understand just the basics of how to calculate these things and then how to use this calculator for whatever property you might be toying around with and trying to figure out. So to start with, we're going to go through and look at this calculator. Essentially, anytime you see a yellow number in this calculator, those are numbers that most definitely you will need to obtain from the listing agent or the seller, depending on the property, in order to best calculate all of this data. For any of these slots that are not yellow, you can either enter a number in, or if you complete all of the yellow slots, they will automatically calculate it for you. So one of the first things you're going to need to know, obviously the purchase price, and then we have initial cost. That's going to be a common term that you're going to want to make sure you understand. And it's exactly what it sounds like. It is the total cost of acquiring the property. So it includes the purchase price, it includes the closing costs, it's going to include any repairs or renovations that they do, and any other upfront costs that are included to make that happen. And something slightly different that is also going to matter is this initial cash investment. And a lot of people get these two terms confused. They are not the same. The cash investment represents just that, the amount of cash that that buyer put into the property in order to secure it and make it theirs. So it's their down payment, their closing costs, and out-of-pocket renovation costs. It does not include anything that was financed in order to obtain that property. And then of course, we've got that data broken down here. If you wanted to estimate, this will be our down payment. This is what we expect to pay on renovations. These are what we estimate for our closing costs. Then that number again will automatically be calculated. Now, as we approach this new changing market, you'll notice that I've actually used the word net closing costs on this form, because that's going to be really important. You are going to need to account for any sort of concession that's happening from seller to buyer on that net sheet, so that you're not overestimating or underestimating the cash to close on this. And now when we look at the income potential for the property, you're going to see two separate sections here. Let me go ahead and click out of that. You're going to see that our actual data, this is the number, these numbers you all want to pull from what's currently happening in that investment property. And then we have over here our best case scenario data. So when you're looking at a property, particularly like a multi-unit property, you want to make sure that you know your absolute best case scenario, okay, your optimistic estimates, and what's actually happening right now. Most investors, when they're looking to buy, they're looking for a deal. And if you're getting a deal, there's a very good chance that that property is not currently operating at its highest and best possible output. So you want to make sure that you understand both what is currently happening and what potentially could happen if you got the property up to snuff and you had minimum vacancies and optimum expenses, okay? So we're going to look at current gross rental income, exactly what it sounds like. That is all of the income that's generated in that property that is exclusively from rental income. That is the rents that the tenants are delivering. Now, one tab below here, we're going to see total gross income, and that includes any other income from the property. That could be like coin-operated laundry, if you have people that pay for parking spaces or any other sort of fees collected, that's going to get included in the total gross income number. I see your comment. This form is outstanding. Will you be sharing it? Absolutely. So we are going to be sharing the link to this form in our follow-up email. We'll also make sure we get it added to our resource library. For those of you who did not actually register for the event, but just showed up for the live, which is totally fine, make sure that you visit our resource library. You can become a member of the site to view that. It does not cost you any money to become a member. It does cost your email address, and I will be sending you some goodies once you're on that mailing list. If you decide you don't like my goodies, you can unsubscribe. It'll hurt my feelings, but I will survive. Okay, moving right along. The next thing you're going to want to understand is operating expenses. Okay, so the operating expenses are exactly what they sound like. These are the costs associated with the day-to-day operations of that property. So property taxes, insurance, utilities, repairs, regular property maintenance, property management fees. That is the operation expenses. We have those figures broken down for you here. If you want to get that data from the listing agent or their seller, fill it out. This number will automatically total, of course. And then we have total expenses. So that's all of your operating expenses plus your mortgage payments, your income taxes on the profit, if any local taxes and fees. If you are going to sell the property, it's also going to include your capital gains and your depreciation recapture. And it's important that you account for all of that in the event that you're analyzing a sale or a future sale of the property. And then we have this fun figure called the annual pre-tax cash flow. And this number often gets confused with the net operating income. So I want to spend some time really explaining it, and you'll see that I've got a long explanation note attached to this. When you guys get your hands on this form, you're going to see that all of these kind of industry terms have a little black corner. When you hover over any cell with a black corner, you're going to get to see my notes to make sure you understand what the function of that particular term is and how you get there. So for the annual pre-tax cash flow, what's important for you to understand is this is going to represent your net cash flow before taxes. It includes, though, all of your operating income and all of your additional gross income. It includes all of your operating expenses and all of your additional gross expenses. It's all of those things in addition to your expected vacancy loss. That's the real difference there, is we're looking at vacancy loss. So if we're assuming that we've got a turnover rate of X%, that's where we account for that number. Now, when we're looking at your current pro forma, okay, we're going to say, all right, well, we're not going to have to do a whole lot of adjustment for vacancy loss because we're just looking at exactly what it is right now. Great. When we're looking at our best case scenario, we're probably assuming a fairly high occupancy rate, right? Like, so if we could get this bad boy up to 100%, this is what the numbers would look like. Realistically, you're going to want to say, let's assume we can get to 85 to 90% occupancy because you want to account for turnover and use those numbers. And that's where this annual pre-tax cash flow really becomes a valuable number because you're accounting for that vacancy rate, if that makes sense. All right. Now, when we have these numbers all plugged in, and in fact, I might just go ahead and plug in some fun numbers. Let's say we're purchasing a property at $750,000. Let's say let's not change any of the formulas. We won't do that. Let's say our down payment, we're putting down $100,000 cash. We're expecting to pay, let's say $50,000 in net closing costs. And we plan on investing, I don't know, we're going to invest $25,000 in renovations. It's in pretty good shape. We don't need a lot, okay? And our gross rental income for this property, let's say that we expect to earn, it's a great income earner, we're going to expect to earn $120,000 annually. And we don't have paid parking. We do expect to earn maybe $10,000 a year in laundry income, and another $5,000 in whatever. Oh no, our gross income isn't working. Let's see. Then we will have to adjust this form. If we've got B 11, 13, and 15. Well, that actually should be just fine. There we go. That makes more sense. Glad we're able to fix that live here. And now we can look at our operating expenses. I honestly have no idea what these expenses might turn into. So we're going to use random numbers for the sake of this formula here. And let's say my property expenses for taxes are going to be $10,000. My insurance is going to be $10,000. My utilities are mostly paid for by the tenants. So I'm going to say that I'm only paying $2,500 a year, and I budget repairs at $10,000 a year. My maintenance is $10,000 a year. These are all fake numbers, obviously. And my management fees are $10,000 a year. Okay, so now I'm looking at an annual pre-tax cash flow of $77,500. Let's say I have no idea what my mortgage payments would be. Darlene would certainly know if you want to chime in with a number. Otherwise, I'm not going to mess with this at this exact moment because I don't want to give us fake numbers. Okay, so now that we have these numbers, you'll see that our actual figures are being calculated for us. So our cap rate on this is going to be about 10.3%, which is a great cap rate, you guys. Depending on the market that you're in, your good cap rate standard is going to vary, right? For some markets, because equity improves so fast, a lot of investors are willing to accept a lower cap rate, knowing that the value itself is going to bring that dollar back to them. In other markets where you don't see fast appreciation, you're going to see investors really look for a really healthy cap rate. And in just about any market, a 10% cap rate would be considered pretty fantastic. To be fair, this cap rate is not going to include our total expenses because I didn't enter them in, so be aware of that. All right. Oh, and I should have defined this for you. So a cap rate is a measure rate of return on an investment property based on its income. So you take the property's net operating income and you divide it by the purchase price in order to calculate what that cap rate is going to be. And then we have cash on cash return here next. This is huge. So this cash on cash return, 44.3%. Is wild. This would be like gold star standard if you were able to get this. So this is the metric that evaluates the income earned on the actual cash that you invested in the property. So keep in mind, we only invested actual cash here, $175,000. And with that $175,000, we're now cash flowing $77,000 every single year. That is a win. So it's important that you understand the return on your cash investment. That's what this figure is here. And then we have our gross rent multiplier. So the gross rent multiplier is most useful for you in terms of determining what purchase price you should offer, okay? The gross rent multiplier here is a metric used for real estate investment. And what it looks at is the value of the property based on its gross rental income. You want to look at comparable properties in the area that are operating either at a similar level or a much higher level so that you can see what the value of your property should be or what the value of your property could be, if that makes sense. And what we do here is we look at the property purchase price divided by the actual rental income. So the higher this number, the better the value, the better the return for that investment. Now, in this example, the gross rent multiplier for this particular property is 6.25. What you would want to do functionally is calculate the gross rent multiplier for comparable properties and make sure that those numbers are either in line or in favor for your client. And now we have our net operating income. This is going to be exactly what it sounds like, okay? So this is the income generated from an investment property after deducting operating expenses, okay? And then right below that, we have our net profit. That will be the income that's left over after deducting your net operating expenses and also your total expenses. So these numbers here that we did not fill out would also be included in that net profit number. The reason they are the same is that we don't have figures here, but just to show that it should be different. Let's say, for example, our mortgage payments on this are, I don't know, we're going to call it $36,000 a year. I think that's probably very low, but just to show this here, we'll see here that that actually drops our cap rate, it changes our cash return, and it's going to change our net profit versus our operating income, which makes total sense, right? And then we have our return on investment. So this is going to measure your profitability for the investment property, and it's calculated by dividing your net profit from the investment by the initial cost of the investment. So not your initial cash investment, but the overall cost, which will include your financed costs. So this is really the gist of what people are looking at when they're evaluating the profitability of an investment property. You do not have to memorize all of this stuff, but it is important that you be able to speak to it intelligently so that when you come across a customer who wants to invest in property, you're able to guide them according to what they need. Now, this section here, this best case scenario, let's say for a moment that this is a relatively small multi-unit property, okay? We'll say we have 2 units that will potentially rent for $1,500 a month. We've got 5 units that will potentially rent for $2,500 a month. And we've got another 5 units that will potentially rent for $3,500 a month, okay? So now we're looking, and what did I estimate here over here? I don't even remember what I said our gross income was. We said $130,000. So we're going to have to make this a little bigger. This last one is going to give us 25 units that will each rent for $4,000 a month. There we go. Now our numbers should make more sense. So we went from 120 to 133 is our best case scenario if we get to full occupancy. And now when we look down here, let's say that our best case scenario, we're going to start renting out parking structures. And we expect that with all of these units, how many do we have? 25, 30, 35, we've got 37 units. We expect to net, I don't know, we'll say $3,700, be $100 a year that we charge for parking. And let's say laundry income, if we get fully occupied here, we think we're going to boost our laundry income to $15,000 a year. And I don't know what our other income is, but let's raise it from $5,000 to $7,000, and we should be doing good. And let's see here. Let's fix our formula. Goodness gracious. Because E24, 5. There we go. Now we see that our best case scenario gross income here is going to be $158,000 each year if we really get everything up to snuff exactly the way we would ideally want it. And now when we talk about our best case scenario operating expenses, there's some things that are not going to be impacted at all by our occupancy rate, right? Like no matter what, our mortgage is going to stay the same. No matter what, our property taxes are probably going to stay about the same. Now, that's not entirely true. You may find that if you increase the value of your property taxes can be adjusted, but we have no way of really estimating how an assessor will make those adjustments. So for the sake of this calculator, we're going to say that is relatively unaffected. And that's why some of these expenses are already accounted for. Now, let's say if we end up increasing our occupancy, well, now our utilities are going to get slightly higher. So we're going to go from 2,500 to 3,000. Same thing for repairs. Now that we have more people living in our property, we're likely to incur more damages. So instead of paying $10,000 a year in repairs, we now expect to pay, say, $10,500 a year or 10,000, not 11,000. So 10,500 a year in there, and we'll do the same thing for maintenance because just things are gonna go wrong. Our management fees, let's assume, are based on a percentage. So instead of 10,000, we're probably gonna be paying somewhere closer to 12,000. And now we're seeing all of these things kind of adjust down. Now, income taxes and local taxes will in fact obviously fluctuate based on your profitability. I'm not going to estimate those because there's just way too many factors that go into it. When you have a consumer physically in front of you, you want to make sure you get that information. What is your tax bracket going to be? What will this income tax look like? And adjust accordingly. And where is this property located? What local assessments do need to be accounted for? And you can put that right in here. But we can see here basically our difference. Our annual pre-tax cash flow currently is $41,500. If we were to max this baby out, our annual pre-tax cash flow is going to go to $66,700. Okay? And what this calculator does for us is shows us what we're currently doing versus what we potentially can do. Hopefully that makes sense for you guys. And I did promise this was going to be a quick one. We're already finished. We are going to be sending this calculator out to you folks. You're more than welcome to use it. When you click the link in our follow-up email, it's automatically going to create a copy for you. If you accidentally mess up a formula, no big deal. You could just click the link again to get a fresh copy. So don't panic. I hope that was helpful. I look forward to seeing you folks next week. And feel free to reach out if there's anything we can help you with. Bye, guys.